Good weekend. Ira Epstein with your weekend edition of your SPDR ETF stock market wrap-up. And this is for Friday evening, and this is the 10th of February, 2023. So here's the event. We have had a pretty much straight-up market that had gone from basically all of January right in through the first couple of days in February. And now we're starting to get the pullback in the market and the questioning of what's going on. A lot will be answered with the CPI number that is coming out this week. Very important number. Are we going to get a wobble? Now, if you don't and you see a strong CPI, it's another case for Fed to get aggressive. If you get the wobble in it, then the naysayers will come out and say, we told you so, the Fed won't have to stay the whole way, and the rally in the stock market may well be energized again. So it's a game of which side of that it comes out on. Now I was looking and I saw Mexico this week came out and surprised the heck out of the market by going up 0.5 point on their interest rate hike. Surprise. Bank of Canada recently said that they weren't going to do much more, that they wanted to pause a little bit, that they might be in the best interest. And suddenly their jobs number explodes. They were looking for an increase of 15,000. They got 159 or so. So this is an uncertain time right here. And what I personally think is you're going to see more jobs created as we get out of the winter months into the summer months. Now, the good news is service jobs typically aren't as high paying as other parts of the economy. They did a survey, by the way, in Chicago came out today, and they did people that worked at home, people that did hybrid, and people that went to the office most of the time. And what they found is the highest paid was the hybrid. The lowest paid was the one that always had to go to work. Forget the word office. But unfortunately, that's because wages in the service industry, a lot of it counts on tips. And so the pay is lower there, and it's made up with the tips. Just remember, you've got to always look as to how these things are going. I think that's very important. So I'm excited about what's going on. Can things keep going like they did from January to February 2nd and just go up each consecutive time? I doubt it. The rally really began, if you think about it, on December 23rd. We talked about a Santa Claus rally that typically goes to around January 10th or so. It went way beyond then, obviously. Now you're in that pause feature. Will you get another leg, or was that it and the market starts pulling back? That's what you got to start thinking about. You're seeing earnings galore coming out. There are a lot of misses. We saw Lyft get annihilated just recently. Those markets that did go up, such as Disney, gave a chunk of it back, 1, 2, 3. AMC shot up when they announced their seats. They've given back a third of their gain. So got to be careful. You've got to pay attention. Now, if we look at the S&P on a bigger picture, you're still caught on the most recent. Is it there? Is it the break from here all the way down to there? It's in one of these areas, all right? I think it's probably the most recent from that high to that low, and you're just sort of stuck right here trying to figure out what the next move is going to be. Are we trending? Well, it depends what you define as a trend. For me, a trend is when you make higher highs and higher lows. There are thrusts in the market. You're in a thrust. That thrust began here just before the end of the year, and it carried straight on up, and this is the first week we've looked back where the market has had a high that didn't take out a prior high. That's quite a while. 1, 2, 3, 4, 5, 6 weeks, month and a half, each one of those making its move higher. Very impressive. When I add to that where the other moving averages are, you happen to have one above the market, the 100-week. You have the 18-week for support right there in the red. When we look at Bollinger Bands, you tell me where the market stopped. It went right up to the 100-week average and the upper Bollinger Band. Remember, in Bollinger Bands, you only get over or under them and stay that way for 5% of the time. The algorithm will make adjustments, or the market will make an adjustment. But so many traders look at it that if you learn how to use it the way that I teach, and it's on our course, you can go get that there. I think you'll have a good time with that. It's on our website at iraepstein.com under education. Go look at the course. So you get up there, that's what the market is fighting. Let's assume that you get bullish information on Tuesday. Well, you've got to prove you can get up and over the Bollinger Band and stay there. That's not going to be easy. It's going to be difficult. If you get bearish information, in other words, a wobble in the market or CPI actually picks up, boom, you can be back down into the 390s, low 390s before you know what's going on. Again, there's no trend in the market at this point, and you are, in my opinion, overbought in addition. When we come to KBE, the bank index, I'm going to repeat. You went up, it got up to the Bollinger Band and the 100-day average. If you understand how I teach trading in it, that is the spot where on a weekly chart, traders should have evacuated all long positions. You're not embedded. Embedded means that you've got the slow stochastic where they're either going the blue and the red sideways underneath 20 or over 80 sideways. They were doing it back over in this area there. And when they lose it, the game changes again. You don't embed all that often, but when you don't embed, you respect these lines as being resistance, support. You normally get a bounce off of them. In XLI, the industrial sector spider, this is what you call embedded. So until it's lost by the red line closing under 79, I contend on the pullbacks in the market the trade is buying. In addition, if the 18-day average crosses the green on a closing basis by the end of the week, that would be a bullish crossover and calls potentially for a move back to the 107.61 level, which is the upper Bollinger Band. In XLE, you keep fighting at the 18-week moving average of closes. You're narrowed in the Bollinger Bands. Generally, when the bands narrow in, you don't move much one way or the other. Now, the energy's all got a boost today because Russia said they are cutting back 500,000 barrels a day of oil production. Now, Russia says a lot of things, but they've been selling the Urals oil at about $50. That's a substantial discount to where Brent is trading. It is hurting their income each month, definitely getting hurt. And OPEC has made a statement today that they will not make up that 500,000 barrels. Of course, they're not going to make it up. They want to keep prices well bid. And to do that, you don't add more production. And that's what's going on. So I see the market as basically bullish until this week's low is taken out. If it can mount a rally, 95.15 is the target. In FXE, which is the euro, you are looking at a market that's got a higher high, a lower low, and what happened? You lost the embedded reading or not? Now you need to close under 79. It's flirting with it. So what will happen this week is the market's going to look at the CPI number and the dollar either picks up because interest rates got to go higher, or the traders will bet, regardless of what the Fed says, they'll go with the tape and they'll say the Fed's got it all wrong. They'll never stay the course of the year. And what will happen? The dollar will drop. This will rally back. That's the gameplay. And Tuesday's a huge day for that. In the gold market, you lost the embedded reading, which calls for a breakback into the 168.61 to 166.84 level before you take out 181.73, according to the way that I teach what happens when you lose that embedded stochastic. In the gold miners, you've also lost that. You're underneath the key numbers of the 100 and the 200-day average, but this helped me. If you'll recall, when the markets got here, I was telling you on weekly charts, generally speaking, and you got to speak in generalities, nothing's all the time, but generally speaking, the first challenge when you haven't hit a 200 or a 100-day average, the market, even if you get over it, plays with it, and sometimes it sets back. The time you go through it again could be the real time, and then I'd look for the upper Bollinger Band again. But you really got right here, where my finger is, you hit the 100, the 200, and the Bollinger Band. That's where I think the professional money came out, and I think they're out of their long positions now. The odds favor the market falling back to the 18-week average of closes. In Tesla, what a ride this has been, huh? The market went from 101.81, got up this week to as high as 214. So in all practical purposes, it started the year and doubled in price. It can afford a setback, folks. I mean, that's just A phenomenal run. You don't realize how much that's come up. And it really helped a lot of portfolios. ARK certainly got a benefit from it. But has it begun a trend? No, it's an up thrust. So you caught the shorts, you came out. If you understand what I teach, and I teach you this right here, when you have an embedded reading and you lose it, often the market's going to run to these moving averages. In this particular case, it got there. Most of the time, you get a time frame in front of it where you can take advantage of it. For me, that didn't mean anything. You got there. There wasn't much I can do. ARK ran on that news too, and it is setting back with the market at the same way. In Apple, I'm going to repeat. The first challenge of a key moving average is often a problem. So the combination, for me at least, of seeing the 100-week average in the upper Bollinger Band and not being embedded, where the numbers are locked in over 80, I think the pro money came out of this on this rally. In Meta, how often do you stay over the Bollinger Band? 5% of the time. My rule of thumb is I take each consecutive week over the Bollinger Band. So if you look at it this week, you finished week 1 over the Bollinger Band. Week 2 was last week. Week 3 is this week. No, you closed back under it. You're at 174.15 and 174.16. Each consecutive week, from the way that I use charting, as a rule of thumb, I take 1 of the percentage points away. So if you're over the band and you 5% of the time, you got 4% chance next week of staying at over. 2 of them in a row, you got a 3% chance. And it's a good rule of thumb. Now, if it gets beyond 5, it's telling you a very important story of strength in the market. It's not normal strength, it's abnormal. And that means on the pullbacks, you're probably not going to drop as much as you normally think you would. In TLT, you have an overbought market that is suddenly caught in the thralls, just like BND, just like you're looking at all the 210 curve yield spreads where the market's concerned with what's going on. You know, the stock market rally flies right in the face of what the Fed wants to see. The strong employment is still there. When you think about it, when we saw the unemployment claims this week, they're still not strong. I mean, during the pandemic, we were getting 800,000. We're at 196,000 a week. It's very low. It's not strong. Sorry, that's not what I wanted to show. So I look at it this way, and I say to myself, well, what can you do? Well, in the mornings, I want you to join me. And I use the word join me. At 9 in the morning, I'm recording a SPDR ETF video. And I record it and post it shortly afterwards. I cover futures first at 5:30 a.m. I cover all the SPDRs, the ETFs. I'm going to talk technical trade analysis. I'm going to give you some fundamentals for the day. Then we're going to take the charts and we're going to go through 40 charts and build them together. I'm always rotating what we're doing. So whatever's coming in vogue, I will switch, drop one, go to another. And that becomes the fun part of it, because what we're trying to do is catch the movements of them, ideally via the charts, before the action all grabs hold. And the reason I cover the futures first is, number one, futures trade 23 hours a day. You really don't trade stocks. There's an aftermarket, but if you go to TD, go to Ameritrade, go to all of them you want, it's very difficult to trade the aftermarket. You can trade the regular market. All of my futures relate to the SPDRs, the ETFs that you also have. So which hand do you want to trade with? I just did a special report, as you know, on gasoline. Well, UGA covers that, and I've got that covered on everything, and gasoline has come up nicely. So how do you join me? It's simple. Go to our website, go under research, tells you everything you need to know there. You can anytime click up here, by the way, and it'll take you to that step as well. Click the icon, it'll get you there. You can always call my staff, they'll work with you. I'm Ira Epstein. You have a great weekend. I will catch you all come Monday morning. Join me. I will see you then.